Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosher.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod, where we amplify voices from across the industry, aggregate those perspectives, and elevate our collective thinking around strategy execution. I'm your host, Joe Mosher, and I appreciate you choosing to spend your time with us today. A quick reminder before today's episode to like and subscribe to the show wherever you get your podcasts so you never miss an episode. And if you're so inclined, at the end of today's show, I would love it if you consider leaving us a review and letting us know how we're doing. Today is an interesting milestone for us. This is episode 150 of the podcast, which, as I sit here in my office and say it into the mic, is kind of remarkable. We started this program just under 3 years ago. A lot of different thoughts around what it could be, what purpose it would serve, what it might create. But looking back, several years back, I don't know that I thought that it would be here 3 years from now. So episode 150 is really quite a milestone and something I'm sitting with and reflecting upon. It also coincides with the launch of the underlying business that funds it, and that's Mosher Consulting Group, my consulting practice that I launched in early 2021. You know, the origin story of the business is that I spent quite a bit of time at Cargill in a variety of roles, had an appetite for doing something different, had an untested hypothesis around opportunities to serve small to lower middle market agribusinesses in the industry that I've come to really love and appreciate and admire, and ultimately decided to step out and take the leap and give it a try. And so we are now not just reflecting upon 150 episodes and 3 years of producing this podcast, but 5 years of being out on my own, helping to grow and lead a business to serve a variety of clients and do it without the infrastructure and some of the creature comforts and the perceived stability of a corporate career. And so it's an interesting time, and it's also this end of year, start of a new year period that causes many of us to be very self-reflective. Now, I'll be honest, I understand that there's this obligatory milestone episode format that podcast hosts do. Like I said, it does feel obligatory. I don't always love them if they feel forced. But as I've been sitting here and thinking about the last 5 years of the business, and then specifically thinking about what do I want the next 5 to 10 years of the business to look like, spoiler alert, I want it to be much more intentional than the startup phase has been. There have been several lessons that have come to the surface that I think is worth highlighting. 4 lessons in particular that I learned during the first 5 years of starting my own business and my own consulting practice. But not just that I learned them in the first 5 years, it's that specifically in 2025, in many different ways, I had to relearn them. And I think they're somewhat timeless. They have broad applicability, whether you're starting on your own, where you work for a large corporation, you work for a smaller outfit, whatever the stage of the business and your role within that business is, I think they have broad applicability. And that's what I want to spend time talking about today. Really quickly, just running through what they are, we need to spend some time with a careful calibration and periodic recalibration of our perceptions of risk. We need to recognize that planning is futile, but it's still incredibly important. And there's a tension there. We need to remind ourselves that uncertainty is opportunity hiding in plain sight. And we need to make sure we're not chasing uncertainty away or beating it out of the system, lest we put opportunities at risk. And finally, relationships, often treated as currency, are in fact assets if you look at them differently. And so that's what I want to talk about today. So in the first case, let's talk about perception of risk. We talk a lot in business around people's risk appetite or their risk aversion, how eagerly they take on risk or how fervently they work to avoid it and remove it from the system. But I think when we kind of step back from that, we need to also look at one of the core components, which is what is your underlying perspective of risk? How informed is it? What are the assumptions that you've made that create that perception? In the context of the 5-year journey of Mosher Consulting Group, I look back at my years working with a large corporation, and one of the things that was always perceived to be true is that when you have full-time employment, particularly with a large organization one that's been around for more than 100 years, you have stability. You have stability of your position, stability of support for your growth, a certain predictability in which your future earnings might be over the course of your career, and all the different opportunities and skills and experiences that you could accumulate therein. And conversely, people would look at self-employment and see that that's very risk on, right? You've stripped away all of those, the creature comforts of a corporate career, all of the back office support for the way you get your work done, the fact that you're actually a W-2 employee, which has all sorts of implications for your medical and health benefits, for your self-employment taxes and FICA in the US, on and on and on. But what I've discovered is, when you work for somebody else, that's just a perception of stability. You've actually forfeit the opportunity to create in its entirety what your future may look like. And this is not to romanticize self-employment or entrepreneurship and say that once you shrug off the chains of having a boss, you suddenly are free to create and be wildly successful. That's not always the case. There is a lot of benefit to the sometimes real, sometimes perceived nature of stable and full-time employment. But at the end of the day, it's still the perception of stability because you actually don't have decision rights around what your future is. You still are putting your career potential, your advancement, the opportunities you can go after, the ways in which you can go after them and position yourself, they are in someone else's hands. And yes, stable full-time employment with another company may provide you somewhat of a buffer and a time delay in an economic downturn. As an independent consultant, I can tell you when things get rocky, there's a pretty short delay between when your clients experience that rockiness and when it starts to show up in your business. Maybe in a large organization, things start to get pretty choppy in the market. Maybe there's a 3-month, a 6-month, a 1-year delay before you feel it within your own position and the work that you do. And some people look at that delay as an asset, right? It gives you time. It gives you the chance to weather the storm, gives you a chance to prepare. But I actually look at that delay as a liability, not an asset. I've discovered that understanding that the instability is there, that there's some risk there, but also there's higher ownership and opportunity for me to act, to put my fingerprints on my own future, for you business owners out there to act and put the fingerprints on the future of your organizations, to direct your teams to change the way they're doing their work and what they're focused on. That is the real asset, that flexibility, that buffer, that time delay between economic dislocation and actually job impact is not doing you any favors. As I reflect upon now being a business owner and working for myself, one of the most starkest sort of differences is I don't have bosses anymore. Yes, I have clients that I have to serve, but I don't have bosses that direct my day-to-day work. I don't have people who set my goals and priorities for me. I don't have people who judge my performance in the context of a review. They judge it in the context of the quality of the output, sure, is in the form of a client, but I don't have bosses in the conventional sense. I have a set of incentives. And as I think about this in the context of the perception of risk, when you think about, okay, look, you can take on a bit more risk, but you can create crystal clarity between the actions that you take, responding to the incentives that you have to produce the outcomes that you want. That is very clarifying. It's very liberating. And at the end of the day, this isn't rah, rah, rah for everyone to become an entrepreneur, to quit your full-time job, to go out and do your own thing. I don't know that it's true for everybody. It's really not true for everybody all the time. But the underlying message is to really sit down and rather than thinking about, am I risk on or risk off? Do I have appetite for risk or do I have risk aversion? Do I seek it or avoid it? Sit down and say first, okay, look, before I decide how I want to respond to this risk, what is driving my perception of the risk? Calibrate it. Is it actually as accurate as you might think? The second point that I wanted to highlight is that business planning, I think, is frankly, it's futile, but it's incredibly important. So you guys have all heard me say before on this podcast that building a business is a process of discovery, not design. Right? So if you sit down and try to design things from their inception, this is exactly how we're going to position. This is how we're going to market. This is how we're going to serve. This is what we're going to do. Here's what the sales cycle is going to look like. Here's what customer retention will look like. Here's our profitability and margins. And I'm going to plug it all into the spreadsheet, and I'm going to extrapolate that out 5 to 10 years. And here's what the business is going to look like. You might be very, very excited about what you see as an output of all those macros. I doubt that it's going to have any sort of resemblance of what the business will look like when you get there. But still, planning is important. It's important because it forces you to sit down and really work through some very naughty and nasty but necessary questions. The important part here is, though, that you work through these questions, but you have an endpoint in mind that forces you to move beyond analysis, move beyond projection, and move into the phase of taking action. Now, as a little side note, when I started my business, the state of Michigan has, through their state sort of subsidiary of the Small Business Administration, they've got a program that supports entrepreneurs that are starting their own business. And you sit down for, I think it was a 1 hour or 1.5 hour sort of Zoom call with a bunch of other new entrants into the business entrepreneurship world. You sit down and you go through this webinar, and it goes through some basic tenets of starting a business. What is a P&L? What's a balance sheet? Your financial statements, pricing, LLC versus C Corp versus S Corp, all the different sort of blocking and tackling components. And the reason you do it is, one, to do knowledge building for the folks that maybe haven't had exposure to that before. But then also on the other side of that 1 to 1.5 hour webinar is access to an individual business coach. And so I was sitting in that first call. A good deal of the content was refresher for me. All of it, though, entirely was helpful. And I'm sitting there with people who are going to start mental health counseling practices. People are going to start mobile plumbing emergency repair businesses. Some folks that were going to open up brick and mortar retail shops. And then there's me kind of thinking about professional advisory services and agribusiness. So a real island of misfit toys. I get to their side. I get assigned a small business consultant, and I was very fortunate. I was very concerned that with the cohort of people I was sitting with, if the consultants were there to support people who are going to do brick and mortar retail operations or mobile HVAC and plumbing repair, are they going to be able to help me create an effective advisory services business? That fear was for naught, because at the back end of it, I got assigned a consultant who actually came from one of the big four consulting houses and done a lot of work in DC on government projects. So high complexity, varied sort of client profiles, very rigorous sort of sales cycle requirements, things that would not actually apply in my business, but had forced her to really sharpen the pencils and sharpen the thinking around how do you build a practice out of that. And so we sat down and started to do the work together, get to know each other. I was given, a great deal of comfort by her background and her approach. And at the end of our first call, I think it was, she said, "Okay, Joe, I need you to develop a business plan and work on that. And then when you have that ready, let's have our next call." And I said, I don't need a business plan. And she said, "What? Why not?" And I said, "Well, I'm pretty fiscally responsible. We've been putting away cash for quite a bit of time. We save a lot. I had a structured exit from my corporate job, so there's some severance money, which is actually the seed capital to give me the freedom to do this. The business itself doesn't require anything more than a laptop, a headset, and internet connection, right?" And she said, "We still need a business plan." I said, I don't. I'm not going to go to a lender. I don't need a line of credit for this business. I don't need to raise investment capital. I'm not going to sell equity. As a side note, who would buy equity in this thing? And so we had this kind of locked horns. And she kept saying, "You have to. You really need to do this." I said, "No, I don't. I don't want to do it." And she said, "Well, look, politely, I'm going to put my foot down, and unless you do it, we're not going to be able to move forward with this consulting or this coaching relationship." So I decided not to play chicken, and I sat down. I started working through the business plan. Now, she did make one concession. She said, "Look, you don't have to figure out the lending and funding side. If you're not raising capital, you can skip that component." So I spent the next 3-4 weeks working through a business plan. And when I say that business planning is important because it forces necessary questions, this is exactly what I'm talking about. I had to sit down and think in a rigorous, structured way that was going to be codified in a presentation and delivered back to somebody else. What is it actually that I want to do? What's my value proposition to the market, right? Why am I uniquely positioned to do the work that I do? And then in terms of the market, who are they, right? Articulate your ideal target market. Then from there, okay, how many of them are out there? How many of them are going to need what you offer? How often are they going to need it? What's going to be their perception of value of that product or service? Based on their perception of value, the frequency that they need it, and how many options they have, what does that impute through to your pricing? How are you going to position your services? How are you going to get in front of these people? How do you create a repeatable flow of new clients or new projects such that you could actually create a business and not just be chasing projects desperately, day to day, week to week, month to month, or quarter to quarter? And then also, who else is out there doing it, right? Like, who are you going to run into headlong? Who's doing the same type of work, but for a varied client base? And who's doing somewhat different work, but targeting the same exact people that you are? Who are you going to brush up against? Are they partners or competitors? Have to navigate all that. And so I suddenly found myself really forced to dig into these questions that I was so ready to avoid under the simple excuse of, I don't need to raise capital. I don't need a lender to back me. And if I look back at that, now that business plan, it's kind of comical on how far off it is from what the work that I do now, the work that I do also with some of the folks that support me. But that's not the point. It wasn't about, am I going to be accurate projecting out 60 months into the future, 5 years into the future? But it's, have I thought about those things? And it started to, force me to step into and step forward with some of that ambiguity that was out there. And I don't think that I've become any more comfortable with ambiguity over time, but it's certainly become much less intimidating. And it's also helped inform the work that I do with agribusiness executives around, we need to develop robust plans for how you're going to activate your strategy. You need to have plans in place around the way you're going to do certain work. You need to have facts upon which you base those plans. But at the same time, we need to know that this is a finite exercise, and that at some point we're going to stop with the planning with the full faith and comfort of the fact that things are going to change once we start to put this into action. And the thinking that the planning has forced us to do is going to be what's of value, not the words that we necessarily put down on paper. And so again, planning might be futile, but it's absolutely important.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
And that brings me to the third topic I wanted to talk about today, and that's uncertainty. Specifically, uncertainty is really opportunity hiding in plain sight. Anything novel, anything new that you want to try to build, to deliver, to package, to support, whatever it might be, it's going to have a degree of uncertainty tied to it. And the further afield you go from what others have done or tried, the more you divert away from what is conventional, common, and expected, the more that uncertainty is going to accumulate. And so in many ways, this creates a disincentive to trying things that are radically new, right? Because to try something radically new means you have to actually seek out and embrace more uncertainty. This has some parallels back to my original point around perception of risk, but it's a somewhat different concept. And when you're starting a new business, launching a new product, getting into a new service line, all that uncertainty is going to be there as the business evolves. But again, it's that uncertainty that really signals that's where opportunity lies. Now, you can look at that uncertainty that's sort of acting as a force field around the opportunity you want to get after. Will this work? Can we do it? Will people pay for it? Will they come back and pay for it again? All the different economics around a business decision are there. But as you're looking at the uncertainty that's sort of veiling the opportunity, you can try to analyze it all away. You can dig in and start to just sort of pick away at it and sort of dilute the uncertainty. You can keep assessing, keep digging, keep grinding away at it. But in the process of doing that, what you're really trying to do is you're trying to reduce the daylight between the uncertainty that you perceive and the certainty that you want. The certainty that you want that tells you it's okay to now chase this opportunity. And so that's completely rational. Who wouldn't want more certainty in a set of actions they're going to take, a course of action they're going to choose? Right? It's completely logical. But the thing is when you're in the process of a business evolution through products, services, positioning, territories, growth, as you try to grind away and whittle away that uncertainty, you're also risking that you might potentially be reducing the opportunity along with it. As you're doing all that work to reduce the uncertainty, others may come along and discover that opportunity as well, and they might act first. You could find that the economic or competitive conditions that are the context in which you're competing might shift, and they might reduce that potential, right? You might be, find that you get stuck in this doom loop of, I need ever more information. Okay, I've got the answers to these questions now. We need these questions answered. And throughout it all, you feel like you're really valiantly and diligently working to get to that level of certainty that you want, when in fact, what you're really doing is working very hard to keep yourself away from making a risky decision. And just like I said in the point around building that multi-year spreadsheet and outlook for your business, not everything can be reduced down to a cell formula. Not everything can be perfectly captured in a pivot table in an Excel file. In Mosher Consulting Group, we've tried several new avenues that didn't materialize as durable, repeatable offerings, right? And they all had that moment where I was looking at them, saying, okay, is there something here? Is there something not? I could have gotten some more information. I could talk to some more past clients or some more prospects to get some more information, but we at some point said, okay, let's go ahead and just try it. They looked very promising, and some of them didn't materialize. Now, maybe they didn't materialize not because they weren't good opportunities. Maybe it was a lack of marketing and positioning prowess, which I'm completely guilty of, and something I'll be working on in 2026. Maybe it was a great set of actions. In some cases, we had work we did with clients that sort of evolved with the client. We produced something bespoke for them, and it was a radical game changer. And they said, we love this. This is exactly what we needed. Not what we expected, but thank you. And so we looked at that and said, okay, well, maybe that's, maybe that set of actions and services, maybe other people need that, right? Let's get lightning in a bottle and let's lift it and shift it over here and try it with some other clients. And then what we found is, it might have been just that specific client with those specific characteristics that they had at that specific moment in time, either in their company's growth trajectory or the economic conditions or the commodity cycle, whatever it was. And as much as I was interested in repeating that kind of work, delivering that kind of value to a client, as interested I was in that and the potential of extrapolating that one project into an entirely new line of business, eventually the facts on the ground just didn't support it. We didn't get the repeat interest. We didn't get the same kind of traction in talking about with clients. We didn't have the same people clamoring for that kind of an output. So we said, okay, look, thankfully, we didn't spend 6 months analyzing it and developing perfect, IP protected methods and templates and everything around this, because that would have all been lost. We experimented, we tried, we quote unquote failed, but failed with very little cost because we adjusted to what the clients needed in the meantime. Conversely, there's work that we do now around board facilitation, particularly with co-ops, but not exclusively. And a lot of, and I hate to use this term, but strategic planning, facilitation that all sort of originated organically over time. Clients saying, this is, we like working with you. We like your approach and style. There's a cultural fit there with our organization, and we'd like you to do this. And so it was something that I had always speculated that was probably more repeatable. Other folks had established processes. There was no way to position there. And so I never really stepped into it. But then now all of a sudden it's among the fastest growing service lines that we had. And frankly, my hesitation over several years is probably the only thing that has prevented it from taking off sooner. Right. And so I think that your instincts and my instincts and our instincts to analyze and plan are healthy. But when they override a bias to act, they tip over into sort of a restrictive self-protection mechanism, which is, again, ostensibly protecting us from failure, but in actuality, it's preventing us from experimenting, doing some low to no risk experiments, learning from them, getting that immediate feedback from the market, and in either moving forward with a profitable new offering or failing fast, adjusting and moving on to the next thing. Uncertainty, whether you're starting a consulting business or running a massive established agribusiness, uncertainty is a bug. Is not a bug, sorry. It's a feature. It's a feature of being an entrepreneur. It's a feature of being a thought leader in your organization. It's a feature of being a business builder. And it's not something that we should be avoiding. And the last thing that I wanted to talk about is really how we treat relationships in our work lives. This likely has applicability outside of agribusiness, but of course, in this show, we talk about agribusiness. There's an adage in professional services that relationships are currency. And that currency monetizes in the form of referrals, right? So you do some good work, you've got some trusted people, and then later on, you farm them for referrals. And those referrals then become new projects with new people. You build relationships, then you farm those for referrals. And I guess that's true, but I've never really liked the idea of quote unquote monetizing my network. Now, granted, when I started my business, the first few projects that we landed could all be pretty directly tied to people that I knew from my professional career. So I guess in a way, I was monetizing my network. I was leveraging relationships into fee generating projects. But be that as it may, my discomfort with that underlying concept of monetizing your network, treating relationships like currency, it remains. For me, thinking about relationships as spendable or redeemable currency just feels transactional. And I think it's going to become problematic over time. Bear with me for a moment here as I take a bit of an aside, but we live in a world where information asymmetries are collapsing, right? There used to be a point in time where the largest grain trading houses had, daily weather reports in from the multiple geographies where they had grain originators and operators. They would aggregate the conditions on the ground. They would roll that up into internal reports. They would then get on global trade calls. They would take position risk or take, reduce position risk based on that. And that was a competitive advantage. And to some degree, those things are still there. But over time, the ubiquity of weather data, of production data, of sentiment data, that started to front run what used to be the proprietary insights of a lot of these large trading houses. And that's an example of information asymmetry between what the market had and what these operators had starts to collapse. And I think that's going to accelerate. And when that happens, transactional business models are going to suffer with them. So think about a business, maybe it's a bespoke brokerage or small trading outfit that looks at trading on spreads and trying to arbitrage different point in time market dislocations, whether it be freight availability, commodity surplus and deficit, basis spreads, whatever it is. They can act very quickly to identify that, act on that, and produce some profitable results. But the problem is after you make that successful trade, after that trade is done and has closed, you reset to zero. And now you need to find the next one. The only thing that accumulates is experience with your team and with the counterparties. But it doesn't necessarily, one good trade doesn't beget the next necessarily. And similarly, when you traffic in very important proprietary insights, you kind of can fall into this transactional trap as well. With the rapid acceleration of technology that we talked about, with the ubiquity of novel modes of collecting and presenting information, that trade of intelligence for dollars starts to get a little bit more at risk. starts to feel a little bit more transactional. And that's the parallel I want to draw to looking at your virtual Rolodex. For those of you that still know what a Rolodex is, looking at your virtual Rolodex and looking at it as, well, that's just raw earth that is ready to be mined for sales. That kind of mindset, for me, it just feels extractive, and it's certainly transactional. Currency spends once. You've got the change in the cash in your hand, you trade it, it's now gone. But assets, conversely, can throw off returns over an extended period of time. And perhaps if the asset is even strong enough and established enough, it can maybe throw off returns into perpetuity. The world we live in now, as fragmented as we are, with social media algorithms forcing us into different groups and profiles within our different social media channels, the online self-service customer portals that we all use to do everything from book a flight to sign in to pay your internet bill, check your blood tests after a routine physical, whatever it is, that type of model, as well as all the bots that are intermediating our attempts to solve problems, right? Good luck talking to anybody the first time you try to contact a company. You're probably going to get a bot, whether it's on a screen or in your ear, that's going to try to jump in front and solve the problem before they actually have to assign a person to it. The world we live in is constantly looking to fragment us and to intermediate the way we work together. But I believe that the world simultaneously still puts a real value, perhaps even an appreciating value, and a premium on relationships and connections. Relationships in your professional life, they're opportunities to learn, to be exposed to different ways of thinking, to wrestle with ideas that are familiar or uncomfortable, and not in a way that's, rage bait being fed to you on Facebook, but from maybe somebody that you really admire and trust and respect, who has a fundamentally different point of view on an issue than you. And you can actually get into that and work through that and understand where they're coming from and find the merits in their argument, not necessarily to change your own, but to improve your thinking around the topic. The relationships and the sharing of ideas like that's the fertile soil in business for new observations, for new insights. Those observations and insights that might tip over into new experiments, new products, new partnerships, new categories, or new businesses. And here's the other thing that I've noticed. When you start to invest in relationships, and I mean genuinely and meaningfully, they very quickly start to look and behave like an asset that spits out currency while replenishing itself. I'm talking, of course, now about the podcast. None of this was an operating thesis of the Pacesetter Pod when we started it 3 years ago. I had a point of view that there were stories out there worth sharing, including some of my own points of view, but more importantly, leaders in the industry, that they were worth sharing. They're worth collecting, packaging, and distributing to the world in an evergreen format. But I don't think even then I fully appreciated the impact that it would have upon me and on the circle of people that I move with, of spending focused, intellectually rigorous time with others and what that would create. So here's some quick stats. Since launching the pod in March of 2023, we've released now, as you know, about 150 episodes, or exactly 150 episodes as of the day this comes out. We've never missed a week, and we've generated roughly, if my math is correct, slightly somewhere between 80 to 90 hours of content. And again, if my math is correct, in that 80 to 90 hours of content, we've had 80 guests on the show. For about 60 of those hours has been conversations, real connection that's also then amplified and distributed for other people to listen into. 60 hours with forward-thinking, self-reflective leaders and thinkers in our industry. Those hours are investments that I'm starting to see have real-world returns for me personally, and I hope for the industry widely of ag and agribusinesses that we've all committed ourselves to. Many of the guests that I've had on the show, I'm in contact with on a regular basis. Sometimes we've worked together on projects. We often share issues or opportunities. Sometimes we're figuring out who we collectively know that we can bring into a different conversation around a novel challenge someone's experiencing. it spins off benefits on a kind of a self-perpetuating basis. And yes, sure, the podcast has a secondary commercial objective of helping to cultivate and build a brand for the business, and our mission of amplifying voices and aggregating perspectives and working to elevate thinking around strategy execution. But all of that has kind of become the real asset. And the reason I bring this up here today as I get to the close is that observation around the podcast. I can pan back, and the pod is actually a great microcosm of everything that we've talked about today. The podcast and the experience of starting this, concurrent with starting the business, is it illustrated how I needed to recalibrate my perception of risk. I spent a lot of time, how much investments is this going to require to get off the ground? Am I going to be able to perform behind a microphone, which is still an open question, TBD? Will it be any good? Also up for debate. Will anyone listen? Well, up and to the right, every week, every month, more and more people tune in. But I had to recalibrate my perception of risk. Was it actually as risky as I thought? And was that risk enough to stop me from taking action? It also demonstrated the importance of planning, but only to a point. And then the importance of taking action, of just hitting record, of putting that first, and it's so cringe. And I will not go back to listen to it, but I will not take it down. Putting that first episode out there. The plans that we build for our business and our projects and our products, they help improve our thinking. But we have to know that they're going to quickly become an interesting corporate artifact that we revisit from time to time. They're not a compass that takes us all the way from start to destination. But even if it's not a compass, you still need to do that work. And then in terms of the uncertainty, there are times where we've tried different things in terms of format and content on this show. Some of them that performed very well, others that didn't. Sometimes I'm not entirely sure why one performs better than another, but we still look at that and try to understand what happened. You try, you learn, you adapt, and you try again. The pod now barely represents where it started. Right? I have far fewer notes of what I want to say. I have far less guest prep for what we're going to talk about. It's much more meandering and sort of genuinely curious and exploration based as we get into these topics, because that's how humans want to communicate. That's how I think. And the underlying point then again is it's not where we started. And this is what it looks like when you peel back the layers of uncertainty. I'm now working out where the show can actually do something that's needed that others aren't explicitly focused on, versus all the uncertainties, all the reasons, why shouldn't I try that? What should I do? Should I do this? Should I do that? Is someone else doing it? What happens if I fail? Just head trash. You just got to move and try and learn and do. And then finally, relationships are not currency. They're assets. And when you treat them like that, they'll monetize in some very different ways that are not transactional, but are actually transformational for your personal relationships and for your business. I'm going to leave it here for today. We went a little bit longer than I would have anticipated, but I appreciate you listening in. Again, as a recap, recalibrate your perception of risk and what's driving it. Build plans, but don't become encumbered by them. Understand that uncertainty is opportunity hiding in plain sight, and so you shouldn't try to beat uncertainty out of your business. And then invest in relationships. And you can start with a simple mindset shift of treating them like assets, not currency. As I close out year 5 of the Mosher Consulting Group and get into year 6 in 2026, it's going to be a year of renewed exploration for us. I'm going to do a comprehensive review of the portfolio of services that we provide. We're going to think about how they're positioned. We're going to take a critical look at what's working, what's not. We're going to spend some time thinking about where will our clients need help in the next couple of years as we come out of the depths of the cycle that we're in, and where I believe we can be uniquely positioned to be successful. So it's a period of renewal, a period of reflection, and a period of saying, okay, how can we be smarter, better, faster, and ultimately more intentional looking at the next 5 to 10 years of the business? It's an absolute privilege to have you as a listener, and it's an honor that I get to work alongside each of you in agribusiness and do what we do. Thank you for listening to today's program and to today's episode. I appreciate you being part of the Pacesetter Pod community and taking the time to listen and to consider and to ultimately action different ways to improve strategy execution in support of your growing your agribusiness. I look forward to having you join us next time right here on the Pacesetter Pod.
This is thepodcastfactory.com.